So, you might remember Kimberly-Clark's nearly $50 billion acquisition of Kenvue, the maker of Tylenol and other health products. It made headlines and sparked chatter among people who don't regularly follow the stock market. It is a great conversation topic after all. Let's go over the deal's talking points and then highlight some other companies that have varying amounts of murmuring about mergers, as well as some theories of how certain companies could spawn takeover rumors in the future. As the Kimberly-Clark and Kenvue deal demonstrate, mergers, takeovers, and buyouts can act as catalysts to drive stocks up and down due to the potential of polarizing investor sentiment. For instance, Kimberly-Clark attracted immediate concerns from some investors about the deal's risks, mainly amid Kenvue's legal battles and sales struggles, mostly revolving around declining sales, legal risks from Tylenol's alleged links to autism that have yet to be proven, and lawsuits related to its talc-based products. On the other hand, the deal, a mix of cash and stock, brings Kimberly-Clark into new product categories like skincare and pain relief, which offer higher margins than its traditional portfolio of tissues and diapers, leading Kimberly-Clark and its supporters to highlight the great fit and potential cost savings of expanding its market share, particularly in fast-growing international markets, since the acquisition is expected to save $2.1 billion annually after its expected close in late 2026. Until then, current concerns about controversial and underperforming products are likely to persist as Kimberly-Clark reiterates the advantages of diversifying its product portfolio. Zooming out to a worldwide view, Globalstar, a satellite communications company, is increasingly becoming a hot target for acquisition, driven by its collaborations with major players like Apple and SpaceX, as well as its expanding capabilities in satellite technology. It provides mobile satellite services, offering global connectivity in remote areas where traditional terrestrial networks don't reach, making it a critical player in today's interconnected world. At the core of Globalstar's appeal is its low Earth orbit, LEO constellation, which provides global coverage, higher capacity, and lower costs with a focus on satellite-enabled IoT, voice, and data services. Its partnership with Apple has been a significant catalyst, with Apple investing $1.5 billion in Globalstar and acquiring a 20% stake in Globalstar, with the goal of enhancing its satellite messaging services for iPhones. As part of the deal, Apple prepays for future service usage and receives exclusive access to 85% of Globalstar's network capacity. This relationship has been instrumental in enabling iPhone users to access satellite connectivity, especially with the introduction of emergency SOS features and satellite texting on Apple devices. On top of that, SpaceX has shown interest in Globalstar, reportedly exploring a potential acquisition, with discussions ongoing about a possible sale valued at over $10 billion. SpaceX and Globalstar have history going back to agreements to launch Globalstar's satellites aboard its Falcon 9 rockets. Beyond these heavy-hitting partnerships, Globalstar is making strides in expanding its satellite and ground infrastructure. It has signed agreements with companies like Parsons Corporation and Hawk Networks to deliver advanced satellite communication solutions for government and defense sectors. These initiatives aim to provide secure and reliable communications, especially in remote and emergency settings. Additionally, Globalstar's work on 5G connectivity using its band N53 spectrum has opened up new opportunities in industrial and enterprise applications, including robotics, autonomous vehicles, and augmented reality. Globalstar's ongoing infrastructure investments, such as the expansion of its C3 satellite system, position it to provide enhanced services in Europe and other regions, particularly in sectors like emergency response and agriculture. For example, its collaboration with TechnoSilva supports wildfire management, and its partnership with Ceres Tag helps monitor livestock health, particularly in remote regions where traditional cellular networks are unavailable. Looking ahead, Globalstar's strong relationships with Apple and SpaceX, along with its growing infrastructure and expanding satellite offerings, are setting the stage for substantial growth. Its increasing presence in the government and defense sectors and its continued focus on satellite IoT and 5G technologies make it a formidable player in the satellite communications industry. With potential for profitability by 2026, Globalstar is positioned for continued success, whether it remains independent or becomes part of a larger tech giant. From a satellite's view, there's also positive sentiment and possible takeover potential coming for an African e-commerce company called Jumia, thanks to speculation about Axion Group's increasing stake in Jumia, leading to rumors of a potential acquisition. Although Jumia hasn't commented directly on the rumors, it has confirmed that discussions with Axion are ongoing, particularly around potential synergies in markets like Senegal. So corporates speak to say kind of, maybe. According to Bloomberg, Mauritius-based Axion Telecom raised $600 million to refinance its debt and potentially fund an acquisition of Jumia. Axion has been increasing its stake in Jumia, holding 8% of the company's shares as of May 2024. The deal, if successful, could help both companies expand across the African continent, leveraging their complementary strengths. A takeover could also result in Jumia being delisted from the New York Stock Exchange, where it has been trading since its 2019 IPO. While discussions are ongoing, no final agreement has been reached, and both companies keep declining to comment on the matter. The potential deal aligns with Axion's broader strategy to expand its footprint across Africa, with the aid of Jumia's established presence. However, such a takeover would still likely face major challenges related to logistics and payment infrastructure. Regardless, the growing digital economy in Africa keeps presenting a fertile ground for expansion. In addition to Axion's boost, Google's announcement of significant investments in Africa's digital infrastructure are likely to result in benefits for Jumia. Google exceeded its 2021 pledge of $1 billion for African internet connectivity, ahead of schedule, and plans to establish 4 strategic subsea cable connectivity hubs across the continent. This move is expected to create new digital corridors within Africa and enhance connectivity between the continent and the rest of the world. Google's investments have already enabled 100 million Africans to access the internet for the first time, and the Equiano subsea cable is projected to boost real GDP in Nigeria by $11.1 billion, $5.8 billion in South Africa, and approximately $290 million for Namibia. On top of that, Google plans to provide free 1-year subscriptions to its Gemini AI Pro plan for college students in 8 African countries, aiming to train 3 million more students, young people, and teachers by 2030, building on the 7 million already trained. As Africa's largest e-commerce platform, Jumia stands to benefit from improved internet connectivity and a digitally skilled population across its markets. The increase in digital access and skills is expected to support Jumia's growth, especially as the region becomes more integrated into the global digital economy. So after years of losses, Jumia is emerging with this indirect help from Google and more direct backing from Axion, signaling a new era towards profitability and creating an evolving narrative about why it could become an attractive acquisition for Axion or another party down the line. While at the same time, Jumia keeps progressing with its own improvements in cost discipline and a focus on core high-growth markets. In Southeast Asia, a similar story could be written about the super app called Grab, which is reportedly pursuing a deal to acquire its Indonesian competitor, Goto. The acquisition would mark a significant development in the Southeast Asian ride-hailing market, but the deal is still subject to successful negotiation of terms and securing necessary financing. A potential deal could value GoTo at around $7 billion, and GoTo would sell its international unit and entire operations in Indonesia, except its finance arm to Grab. However, the deal terms are not finalized, and could change as the two companies are still in negotiations. Grab and Goto have had on-and-off merger talks for years, but competition concerns have previously hindered a deal, and regulators in key markets in Southeast Asia may impose strict scrutiny on the potential merger. The two companies require more time due to conditions proposed by the Indonesian government, which is concerned about market competition and job welfare. Public opposition has also emerged with protests by ride-hailing drivers fearing job losses and price hikes if a Grab and Goto merger creates a monopoly. The government has indicated it wants the merged entity to offer better benefits to drivers and ensure Indonesian majority ownership of Goto, though no specific plan has been outlined. Despite reports of acquisition talks, Grab has publicly denied any discussions or definitive agreements with Goto. Regardless, fuel gets added to the speculation as Grab recently raised $1.5 billion through a convertible bond offer, stating that acquisitions are among the intended uses of the funds. GOTA, currently valued at $4.4 billion, and largely foreign-owned, has also denied having reached any agreement with another party. That being said, a merger could help both companies, which have been posting losses since their IPOs, by reduced costs through operational efficiencies. Grab, itself valued at around $19 billion, has emphasized organic growth and share buybacks while continuing to dismiss any merger plans with GoTo. Though if the combined entity does become a reality, it would dominate around 85% of the $8 billion ride-hailing market in the region. Indeed, such market share is undeniably attention-grabbing despite the immense hurdles that need to be overcome. That's why there are always at least some investors that maintain a positive outlook on Grab's ride-hailing, food delivery, and digital payments business, especially when strong revenue growth of 17.3% took place over the last year, alongside a solid market capitalization heading to the $20 billion range. Now, the next acquisition tale is more of a yarn that hasn't started spinning. In other words, it's just a speculative theory with no evidence yet. More of a hypothetical situation with a mix of real reasoning and imaginative exposition in the emerging world of electric aircraft and air mobility. See, ACHR Aviation is already famous for its midnight electric vertical takeoff and landing eVTOL aircraft. What's less well known is ACHR works with Palantir, the AI and enterprise data analytics juggernaut, to build the AI foundation for this next generation of aviation technologies, both for aircraft manufacturing and operations, whereby Palantir's Foundry and AIP are used to scale ACHR's production capabilities at its Georgia and Silicon Valley facilities, and develop AI for software in other areas of aviation. For instance, enhancing air traffic control, movement management, and route planning, with the goal of improving efficiency, safety, affordability, and sustainability. These are strikingly similar goals as Surf Air Mobility, a company that's maneuvering into position to become a major player in the growing regional air mobility market, which is projected to reach up to $115 billion by 2035. It operates two main segments: air mobility, offering scheduled services and an on-demand charter marketplace, and air technology, which develops aviation software and electrification powertrain technology. Its goal is to revolutionize regional air travel with electrified aircraft, reducing costs and emissions while unlocking new growth opportunities. Surf Air's acquisition of Southern Airways in 2023 expanded its reach across the U.S., including government contracts, while its SurfOS platform is designed to optimize operations for air carriers, brokers, and aircraft owners. This AI-powered software is meant to streamline scheduling, pricing, and operational tasks, improving efficiency and profitability in the industry. As the platform is in beta with customers giving feedback, Surf sees SurfOS getting fully commercialized by 2026. Like ACHR, Surf works with Palantir, benefiting from Palantir's Foundry platform, which could make sense of industry data gathered from Surf to drive efficiency and profitability across the wider aviation industry's airspace as a whole. Surf's reach is extensive, having relationships with over 400 regional air operators who have operated charter flights via its marketplace. These operators are expected to form the initial customer base for SurfOS software. Additionally, Surf has interline agreements with major airlines like United, American, Alaska, and Hawaiian Airlines, extending its reach to their combined 430 million annual passengers. Oh, and another thing, ACHR also works with United Airlines to develop air taxi networks in major U.S. cities. All the more reason Palantir could be a good mutual friend to bring Surf and ACHR together for an amazing symbiotic relationship. Stranger things have happened, you know. It's also not too outlandish to suggest ACHR could acquire Surf to create a wider network and gain more valuable resources plus information that's already associated with its established partner Palantir. Something similar happened not too long ago when Joby Aviation, ACHR's frenemy in the electric VTOL arena, acquired Blade Air Mobility's passenger business for approximately $125 million, helping to accelerate electric air taxi commercialization for urban passenger service. Blade's medical division, which transports organs and provides time-critical medical logistics, was excluded from the deal and remains a separate public company rebranded as Strata Critical Medical, which will partner with Joby for medical transport operations. Joby will become the preferred VTOL partner for Strata's organ transport business, demonstrating the broader applicability of its aircraft in high-value, mission-critical operations. The acquisition is advantageous because it gives Joby immediate access to Blade's network, which served over 50,000 passengers in 2024 from 12 urban terminals. Blade's established infrastructure is located in key urban markets across the U.S. and Europe, including dedicated terminals and lounges at New York City hubs such as JFK, Newark, the west side and east side of Manhattan, and Wall Street. By leveraging Blade's operational expertise and loyal customer base, Joby expects to accelerate commercialization, reduce customer acquisition costs, and transition passengers from conventional helicopters to its next-generation electric aircraft. Joby will integrate its Elevate OS software, designed to manage high-tempo air taxi operations, into Blade's passenger service to enhance efficiency and customer experience. The deal also provides Joby a platform to launch commercial operations in Dubai next year and support subsequent global expansion. The transaction structure allows Joby to pay cash or stock, with $35 million of the total price tied to performance milestones and retention of key employees. To propel passenger service even further, Joby and Uber plan to integrate Blade's passenger services into the Uber app as early as 2026, allowing Uber users to book Blade flights directly through the app, providing access to Blade's established network. The move builds on Joby's ongoing partnership with Uber, which began in 2019, and Joby's acquisition of Uber's Elevate division in 2021. By leveraging Blade's infrastructure, landing points, and dedicated passenger lounges, Joby aims to accelerate the launch of its VTOL air taxis in global markets, not only in Dubai, Los Angeles, and New York, but also the UK and Japan, particularly as integration into Uber's app is expected to increase brand visibility and market access, supporting Joby's broader vision for urban air mobility and sustainable, efficient transport. So if ACHR were to take similar action to merge with Surf, it could reap similar rewards. Not to mention both ACHR and Joby are looking at having their aircraft and technology serve dual use for civilian and military, with both already having ties to Air Force testing. And since Palantir is intertwined with the military, it serves as another common point between ACHR and Surf Air Mobility. So what do you think? How realistic would it be for ACHR to buy Surf? Remember, this is just entertaining speculation for now. Nothing concrete has been reached, let alone the emergence of any rumors from market radio chatter. Oh, how amusing that is. Remember, a few weeks ago, there was supposed evidence Tesla was going to be teaming up with ACHR to get into electric aviation because of videos seemingly showing Tesla cars with electric aircraft? Yeah, that didn't go anywhere. So share your thoughts on this theory about Surf possibly merging with ACHR, and as always, for more on stocks and crypto, follow Ascencore. Thanks for watching and have a nice day.